In the year 2000, Bill Clinton signed the Commodity Futures Modernization Act and ushered in the age of financialization. Without much hesitation, the financial sector began to have an increasing influence over the overall economy. Instead of producing goods or services, large sectors of the economy became dedicated to engineering creative ways to make money with money. Bill Clinton later admitted that he'd made a huge mistake, but it was far too late. The floodgates for market speculation were opened. Ever more exotic financial products were invented and sold. The banks and financial players were supposed to regulate themselves, but this didn't happen. Financial products would be traded privately without supervision. There was no connection to any real-world underlying asset. However, the risks they created in the financial system were real. The speculation finally got out of control in 2008, causing a crisis in the global financial system. There were millions of bailouts for the banks and hedge funds, while millions of ordinary people lost their jobs. Work became scarce, and many struggled to provide for their families. As the dust settled, the anger grew, and in 2011, it erupted into a movement called Occupy Wall Street. Its purpose was to protest against the bankers and show that they couldn't get away with gambling with other people's money. But something strange happened. Within a year, it seemed that everyone lost focus on the financial issue, and instead of challenging the banks and holding them to account, society began to fight one another over their personal differences. Meanwhile, the financial institutions could breathe a sigh of relief at the turn of events. Fast forward to 2020, and a global pandemic would trigger lockdowns around the world. In the United States, about 47% of jobs come from small businesses, so naturally, shutting down the economy spelled economic devastation. With people out of work, and many growing restless with their situation, they began to notice something. While their businesses were shut down and their jobs gone, it seemed that Amazon, Walmart, and other massive corporations were just fine. In fact, they were thriving. Not only this, but the financial markets began to boom. The rich were once again getting richer, while they lost everything. Wealth was being extracted from the little guy to the financialized economy. With jobs gone, nothing to do, and only limited government support in the form of stimulus checks, the stage was set for a revolution against the financial institutions. In 2012, 30-year-old Jamie Rogozinski would browse a forum called Reddit from time to time. He had made some extra cash at the time while working in Washington, D.C. So, Jamie had the idea to gather a community around investing. He would start a subreddit called Wall Street Bets in order to do this. For the first few years, the Wall Street Bets forum only managed a few thousand users. Then in 2019, some brokerage giants eliminated trading commissions for their apps. They made trading free and accessible. In a moment, retail investing exploded onto the scene. The number of Wall Street Bet subscribers quickly grew past 500,000, then 1 million during the crash of March 2020. By this time, the community had taken on a mind of its own. On his YouTube channel, the armchair investor, Keith Gill, laid out his game plan. It was to buy some stock of a company called GameStop, an unassuming store founded in 1984 and familiar to most people in the United States. A small number of Redditors also agreed with Keith, but then they noticed something even more peculiar. 84% of GameStop stock was held as short positions, that is, betting that the price would fall. This was highly unusual. It turned out that hedge funds had colluded in selling short the stock, publicly stating that the price would go down, therefore making them millions. They sold over 130% of the GameStop stock short. While Keith was posting about his findings, another Reddit forum user posted a 7-point document titled, quote, "Bankrupting Institutional Investors for Dummies," featuring GameStop. The user pointed out that hedge funds were fatally exposed. The Wall Street Bets forum loved the idea. It was brilliant. The risk to the Redditors was limited. The worst that could happen is that the stock goes to zero and they lose all their money. On the other hand, the risk to the hedge funds was immense. The hedge funds could lose more money than they put in, and worse still, they had borrowed money to short sell. The plan was for the Reddit army to keep buying GameStop stock, driving up the price and making the hedge funds lose more and more money. The hedge funds would be forced to abandon their positions and cover their losses by buying shares from the market to return to their lenders. As the stock kept rising and the hedge funds kept losing money, Reddit realized that they could bring the hedge funds to their knees. It was a digital form of protest. The masses were playing the banks' and hedge funds' own game against them. By January 26th, GameStop was the single most traded stock in the US stock market, with volumes matching that of the 5 biggest tech giants combined. GameStop saw its share price spike from just a few dollars in 2020 to a peak of over $490, transforming a firm that was valued at less than $200 million in April 2020 into a company worth more than $28 billion. The GameStop rebellion has set a precedent. This is the very first instance of the intersection between social media and the financial system. The idea has since gone global. Bloomberg has reported the targeting of shorted stocks from Amsterdam to Sydney. In Europe, some of the most shorted stocks jumped 20% or more, and in Tokyo, short-sold stocks jumped by about 7% or more. Our trust in the financial system is at an all-time low. Over 23% of all US dollars in existence were printed last year. Meanwhile, 40% of Americans don't have $400 in the bank for emergency expenses. This is from the country that is the world's reserve currency, so it has global implications. This story has revealed how volatile and detached from reality stocks can be these days. Low interest rates, stimulus, excessive financialization, and quantitative easing has transformed the global economy from productive, innovative, and earnings-focused to a decaying husk of speculation and financial engineering.